show of hands, how many sitting in this audience have ever invested in any blockchain technology? All right. How many in this audience have ever taken investment into your blockchain project? Okay. Well, hopefully what I'm going to talk about is going to be relevant to both groups. Because, well, I'm going to start by saying that blockchain investing is complicated. And this slide kind of tells you that we still don't quite know what it is. And we deal with a lot of new and kind of unproven ideas in blockchain when, ideas in investment structures. The technology is new, the assets are new, speculation is rampant and presents its own set of risks, et cetera, et cetera. And when we compare blockchain investments with kind of more traditional investment structures, in more traditional investing, we deploy capital. Some investors are, different from others. Some investors deploy also their experience and relationships, kind of expect capital back. In blockchain and crypto, the picture is a lot more complicated. And I'm talking now as a blockchain investor because the deployment of not only capital is what we do as investors, and it's about resources, it's about knowledge, it's about running computer network nodes, etc. So this sets up the landscape as being quite a bit more complicated than it used to be before blockchain. So what typically goes wrong? Well, here's one example. So when we put money in, we kind of expect money to come back eventually. And there are things that have to go right for that to happen, which start with a great team, great idea, great execution. Everybody already knows how to evaluate that. Then comes the stage of user acquisition, monetization, revenue, and then investor returns on investments. In crypto, these three stages are a lot more questionable than in traditional centralized companies. However, in .com, we saw some of this when investors were creating, exorbitant valuation based on what I call the eyeball fallacy. It's the idea that the more users you have, the more money you're worth, even if you don't have a good monetization model. So this is not new. But in crypto, it's very, it's a strong dynamic that monetization and these last stages of ROI are kind of more under question than usual. And then we have specific risks in addition to traditional investment risks, which are on the left. And that's a set of risks that I list on the right, such as, absent cryptoeconomics and fundamentals, if you're talking about tokens, lockup and speculation dynamics in liquid token markets, which are quite a bit more irrational, and I'm not going to be surprising anybody by saying that, than traditional public equity markets. Incentive misalignments between founders and investors are a huge problem sometimes. Contracts, like there was a lot of criticisms around the SAFT investment structure. And then the fact that investors don't always get the same governance protections in crypto as compared to traditional equity. So speaking more specifically about sort of what typically can go wrong, I have four what I call failure scenarios. Failure scenario number one is you encounter a project that is raising money with equity, looks and feels very traditional, but they're working in crypto. Great team, great product, maybe even great adoption. But you find that their monetization model is lacking. This is a prominent problem in crypto right now, and I don't know if many people talk about it because a lot of times projects in layer 2 wallets and infrastructure tend to punt on the question of monetization. The question of how are you going to make money is typically, well, either we'll figure it out in the future if they're honest, or something like, well, we'll run nodes on our network if they're not. And this is a big problem. There's some ways to mitigate it sometimes by ensuring that ensuring that when and if the company issues tokens, you get rights to them. The company may think today that they're only selling equity, but typically in these market verticals, it is very hard for the company to channel revenue, to channel ROI to equity. So some companies might decide to issue tokens, and in which case the investors will lose if they buy equity, but the company issues tokens. Also, these teams, we expect many of them to be acqui-hired. There's already some examples of that in the space. But in general, this is a hard problem that I don't think we have quite figured out yet in the space of crypto, because as we're layering layers in the stack, and this is especially relevant to the Ethereum ecosystem, because layer 2 wallets and infrastructure are kind of off to the side and are done by independent teams. We have to think about where, how these parts of the stack are going to monetize. Some examples of this dynamic are, we're going to build a cool project and we'll charge people for the premium service of running nodes on this network. Well, the problem is, if you're building a network, you might not be a really good DevOps company. So it's a different orientation, and there are better people to do DevOps for these networks than the creators of the network. So it's hard to buy into this idea as a monetization structure. Another monetization structure is we build a great network and sell products on top of it, but that of course is a very indirect way to test product market fit, and will take a very long time. And then what if you build a great network but your products fail and somebody builds better products? That's a crypto-specific risk that you have to kind of worry about. We're going to build a great network and issue tokens. I already talked about this, but you're selling me equity, so what's up? Clear so far? All right. Failure scenario number 2, you're buying tokens. Again, great team and product, great token model, investors get no equity or governance rights, and then company, typically when they sell tokens, they don't have any controls on how they deploy the capital that they raise by pre-selling tokens. So the problem with that is that this is a huge incentive misalignment, because in many cases the company then goes and becomes a kind of a service provider, and some companies go and consult in the area that they work. So this, for example, is very often the case with resource networks, tokenization platforms, and what I didn't write on the slide and just realized, a lot of academic technologies run the risk of falling into this trap, because they're hard to monetize with tokens, but nevertheless they do raise by selling tokens, and then the companies turn around and finance selling themselves as a consultant in the given area, and then investors get nothing. So again, always get both equity and tokens, even if only one makes sense, and watch out for buying naked tokens on liquid markets, because what's behind those tokens might have this problem. And then also ensure incentive alignment with founders. What you don't want to happen is you don't want to give founders money to spend on something that only benefits them. So make sure that your contract is written in a way that ensures that the founder gets exactly what you get, And then also, work with the founders to receive clarity on use of funds if you're participating in a crowd sale. Some examples of, how this happens is, we build a market for decentralized AI model training. We'll sell AI modeling apps. And what guarantees do I get as an investor that you will work to channel value into the tokens I just bought from you? And we have a great token design, but let's make sure that if you have to pivot or build a centralized services company, that I get the ROI based on that. Failure scenario number 3, it's a kind of a cap table problem that very often happens in token investing. Let's say there are 2 rounds of financing. First one is an early round. Second one is a kind of a later round. Both are successful. The problem is that when the project launches, the early investors can sell their tokens, but the later investors are still under lockup. And of course, I call this a light bulb moment for everybody still under lockup in a sense of an enlightenment, not in the sense of being screwed. And where this happens is if you, buy a SAFT, you really, or you participate in any project where your token allocation is under lockup or vesting. A lot of projects like that come from 2017, and their SAFTs are still trading OTC. You have to watch for lockup provisions and for, cap tables. The point here is to always make sure that you look at the entire cap table, not just your round. And then this is something that people forget to do. Make sure that vesting terms are formulated relative to the launch date of the system or the token in some form, rather than at a specific date, because launch can always get delayed. And then, of course, think about, when somebody is offering you lockups, think about kind of what that lockup is worth to you, because very often projects say, well, you can get 30% discount for for a 1-year lockup, or 15% discount for a 6 months lockup. This has happened many times. Well, if you look at the volatility of crypto markets today, you realize that 15 or 30% is kind of a blip on the crypto volatility radar. And so you have to make sure that the discount you're being offered for a certain duration of lockup is actually commensurate with, with the market as a whole. And I'm not going to name numbers, but it's kind of important to think in those terms. And then finally, failure scenario number 4, related to staking. We at CoinFund actually do participate in networks, and we do staking and validation on many of them, and it's one of the forms of investment that we do. And here's what happens, and again, happened many times. Tokens get issued under lockup, and the network has crypto economics that incentivizes staking by inflating the tokens very sharply in the first 1 or 2 years of the existence of the network. Well, the problem is that if you're not careful with your token purchase and you allow yourself to be locked up, the lockup provision might prevent you from staking your tokens. This is almost always a mistake for both investors and founders. If the founder does this to their investors, they're kind of losing an early class of supporters for their network. And it's very inadvisable, but that happens sometimes. And you have to make sure that in staking networks, when you're dealing with the staking economics, that your lockup provision excludes delegation, that you can delegate even if you're under lockup. Always examine crypto economics and always remember that they may change. This is very hard, and every time I personally evaluate private token sales and look at the ideas that the founders express about how their system is going to work, you always have to think about what might change before the network launches, and it's good to consult with somebody who understands crypto economics really well. You know, also, if you're an investor, then look at structuring your fund so that it can in fact stake, because from the tax perspective in some countries, including the US, staking is sometimes classified as income, not capital gains, and so a lot of funds are unable to do that just because they don't want to put the tax burden on their LPs. So be careful about that. One last kind of point in this presentation is to think about the overall risk of a crypto investment. Think in terms of how many things have to go right for the project to be able to generate ROI. Because generally, many of the crypto projects, this number is much higher than in traditional centralized equity investments. As I said before, there is many steps to ROI, and you know, if you're looking at, for example, a decentralized application building on a layer 2 infrastructure for a layer 1 platform, you know, you're looking at an increase of 2 or 3 times the number of risks that you would be looking at compared to a more traditional project where the founders are more independent of the technology they're building on. So that this doesn't happen. All right, thank you guys. I'm perfectly on time.